been happening in the world of investment markets?
That's good. Well, yes, I think one of the things with regards to the market is, as those of you who viewed our last market update for July have probably spotted that at the end of that we said, well, actually July there's been a lot of bad news, but the markets went up considerably. And so it's probably going to be our luck that in August there'll probably be some good news and the markets will go down, and that's exactly what they did. So many reasons for this, but I think if we start looking around, so July was a great positive month, and probably the first positive month we had of the year, where we could see the investment returns from all the portfolios, and indeed many of the investment funds. So I know we centre a lot on our portfolios, but our investment funds are sort of wide and varied. We got some really good news last month, and then this month we've seen most of the portfolios fall in value, most of the funds fall in value, because really there was a meeting in a place called Jackson Hole, which is over in America, and this guy Jerome Powell is, gosh, dear to me anyway, still in this job, but he delivered more doom and gloom, and oh my word. Well, considering he was the chief culprit who goes into this fiasco, and he was saying that, well, they're going to have to start raising interest rates more aggressively, and doom and gloom end of world stuff. And yet, what's happening when we look at the world is that we're still actually spending quite considerable sums. The consumer confidence index in America in particular has gone up. So we're seeing actually an increased expenditure, and it's all because of this crazy lockdown that we went into. And again, I know we've been banging on about this for months now, but we had sort of the best part of 2 years of lockdown where people were prevented from spending as they would normally. And the consequence of that is now we've got a lot of cash in the world waiting to be spent. And the governments really need to recognise this. It's nothing to do with shortages, it's just we're demanding more. So we say, okay, as soon as the lockdown's finished, perhaps there may be family or friends we want to go and visit, perhaps family and friends we don't want to go and visit. But you get in your car or go in your bus and go on a train, that all demands fuel. And of course, what happens is the lockdowns ended virtually at the same time throughout the world, apart from China and one or two other crazy places. And so people use the energy at the time for going out and about, back into restaurants, etc., which have to be heated, lit, etc. So you just end up with paying more for your fuel because of the supply and demand. It's a supply and demand imbalance. And the other thing we've had for years now is the eco lobby, which is mighty fine and all the rest of it, but we have had then underinvestment in companies like Shell and BP, ExxonMobil, etc., whereby there hasn't been the production capabilities to be able to now switch on at a higher rate the excess oil and gas that we need, because of the fact that there hasn't been that investment. Because for years, with oil and gas being at such a low price, there was no pressure on companies to actually invest because they want to see a profit on it. So we're reaping really a lot of what we're seeing in the world. So gas, for example, here in Europe, in August increased on the Dutch market, which is the biggest gas market in Europe, increased by over 22% in a month. That's crazy. The good thing is, though, now most of Europe is reporting that they've got actually good gas levels in storage tanks and facilities. So that this caused a little sort of price to come down a wee bit. Oil came down as well, although perhaps we don't notice that too much at the pumps, because that's sort of a different story. So it's all a bit of a weird thing. But in America, as we know, the world's biggest economy by a mile, then consumer confidence is up, consumer expenditure is up. Biden, at long last, got the infrastructure and the eco planning bill through, which is pumping billions and billions of dollars into the American economy as well. So really good signs. Inflation looks like it might have peaked, which is good for them. So it's sort of really good signs there. And when we look at the companies reporting, because there's been a big reporting month in August for a lot of the major companies and a lot that we hold within the portfolios or within the funds that we use, then reporting figures were up. So when we look at some of the big companies, a lot of those profits were higher than these so-called experts had predicted. So it's contradicting what you normally may expect to see in a recessionary period, where you'd see results coming in below expectation, you'd see unemployment increasing, you'd see consumer demand falling away and consumer confidence disappearing as well. So it's a completely different world. And unfortunately, I don't think the policymakers have got a grip on this, because simply increasing interest rates, which is what they're now doing, and stopping this quantitative easing, printing cheap money, then it's probably going to have the adverse effect. It's going to actually make the situation worse. Because if you're trying to invest money, so if you're a company and you're wanting to expand, you go to your bank and say, I need to get into this new market. I've got so much demand for my products. And the bank says, well, I'll tell you what, Rachel, if you'd come back to me last year, I could have given you that money at 1% or 2%. But sorry, now you're going to have to pay 7% and it's going to get more expensive. You're like, well, I think I won't bother investing my money in expanding. So anyway, that's just my thought. In France, moving up to Europe, the French economy just escaped going into recession. The second largest economy in Europe. They've got this price cap on energy until the end of this year. Italy are thinking of doing that. They're going through the motions of putting in various price caps at the moment. It's only going to be a matter of time, I think, before the UK has to do this.
Just going to ask that. Do you think UK will?
Yeah, and I think it's got to be done, because simply it's very, very good for the economy. If you can get sort of gas and electricity prices down, then it means people then that would have spent that money on heating and lighting, etc., they've got money to spend elsewhere. And we know so much of the money we spend here goes to the Treasury and tax.
Yes.
So you've got VAT, you've got national insurance contributions, employers, national insurance contributions, income tax, excess duty, excise duty, etc., etc., etc. So if you can actually control that, the amount that you're paying for heating and lighting, then you make a success of it. So it actually brings more revenue in if you sort of do that. But it's probably something that they're going to have to do, because otherwise there's going to be a lot of people in a real pickle. But then we can hopefully get away from it being every headline on the news. Cost of living crisis, so we're going to have another news headline.
Well, talking about headlines, what's happening in Russia? That's been another one that's been dominating the headlines for quite some time.
Well, Russia's doing quite well, actually. The economy in Russia's sort of zooming ahead, and we should probably more invasions, well, obviously not, but the value of the rubles at an all-time high. The Russian government has got more money in foreign revenue than it has for many a year. It's now buying yuan. It's buying the Chinese currency. It's buying Indian currency, Pakistani currency. It's going on a bit of a spending spree, because it's making more for its gas and its oil. Long term, so we transition away from that, and that's going to hit them hard. But the Russian impact has led undoubtedly to inflation, and has led to the likes of Germany, Italy, and Spain having to think long and hard about their long-term energy production, because relying on Russian oil and gas and oil from other parts of the world as well is perhaps not a very good strategy. Going over to China, so China's still embroiled in zero COVID policy, which then has led the likes of Apple to say it's going to be moving quite a bit of its production away from China to India, Taiwan, and other places there where, again, labour is cheap, but they've got good quality sort of workers there, well educated, etc. So this zero COVID policy really hits the world quite badly, because of the fact that if China is not able to sort of get the production out, then it hits the rest of the world, because a lot of the stuff we buy, as we know, comes from China one way or another. For the first time in many a year, the Chinese production levels fell in the last quarter, and it's driven as well by the fact that they have a bit of a property crisis there, with so many investors in property now getting their fingers burnt. And we've still got this issue about tech stock, what the Chinese government think about that, and listing on the US markets and various other things, together with a heat wave, which has left many parts of the country experiencing power blockages as the grid just simply can't cope. But the bigger one with China is, unfortunately, they still have, I think it's just less than 50% of the population inoculated against COVID. So therefore, if they open up in their eyes, they'll probably see mass levels of poorly people. And obviously the size of the Chinese population, it wouldn't be that good. But I think we're in a picture of doom and gloom. But when we look at the basics of it, then unemployment levels, here in the UK and in the US, around about 3.5, 3.8% of the working population, which many people would regard as full employment. It's higher in the likes of France, 7%. It's about 3% in Germany. So there aren't the usual things that we would expect if we are going into a recession. But the difficulty is because so many people talk us about this cost of living crisis, recession, etc., then it scares people.
Yeah.
And it's a self-fulfilling prophecy that you're actually going to get people feeling, oh, well, I won't do that investment. I won't make that purchase because there was one of our clients the other week. I won't mention any names, but she was saying she had stopped putting money. She was going to buy a new car, but she was feeling the effects of all this doom and gloom talk. So she's not going to do that. Well, she's got more money than the last 5 people a normal lifetime, but yet she was worried about the cost of living crisis, and yet for her, it wasn't an issue at all. That's the way
Everybody's feeling it, and that's what we're hearing a lot of.
Yes, that's it. But I think
it does seem a lot of doom and gloom, doesn't it? But
yeah, it's short term.
Is there some good news out there?
Well, I think there's many sort of good news areas, especially about the company results. That we're seeing some good performance from many of the companies that we have indirect share ownership within. The other good thing is that it's never been a better time to invest. In the UK, for example, then markets fell by the highest level in August, which then means that some of the shares on offer through some of the British companies are really good value for money. Income multipliers of less than double digit, which is a fantastic news. So for long-term investors as we are, then it's very good for making money in years to come. The challenge we've got is just how long this sort of period of uncertainty and volatility will last for. And really, we don't know that, but we just hope that the policy makers don't raise interest rates too much further, because that really could cause tremendous long-term harm. We need to keep cheap borrowing, because that then it helps to keep the world actually producing more. But just our opinion.
As we do every month, we'll take a look at the A.R.D. Consultancy portfolio performance over the last month, year, 3 years, and 5 years. The defensive portfolio over the last month, minus 2.3%. Over the last year, minus 11.7%. Over the last 3 years, minus 3.7%. Over the last 5 years, up 6.8%. Cautious portfolio over the last month, minus 1.9%. Over the last year, minus 10.9%. Over the last 3 years, up 1.3%. Over the last 5 years, up 14.7%. Balanced portfolio over the last month, minus 1.9%. Over the last year, minus 12%. Over the last 3 years, up 3.8%. And over the last 5 years, up 23.6%. The capital growth portfolio over the last month is minus 1.5%. Over the last year, minus 11.8%. Over the last 3 years is up 12.8%. And over the last 5 years is up 33.9%. The aggressive portfolio over the last month is minus 1%. Over the last year, minus 10.7%. Over the last 3 years, it's up at 20%. Over the last 5 years is up 46.1%.